So this section of international tax is about global minimum tax. Now, as you would have seen in some of the earlier videos and earlier topics and sessions, in many cases, the rules and the regulations of international tax are used for the purpose of reduction of taxes, sometimes given the name of optimization, sometimes the name of planning, but in many cases, actually avoidance through sophisticated tax planning. And due to which this what happens is that many a times there are countries which acts as facilitator for the purpose of avoidance of taxation. These countries, because of the reason that they want economic activities to flourish into their jurisdiction, foreign money to come into their jurisdiction, they keep the tax rates very low or even nil in some cases. And due to this, what happens is instead of paying taxes in the country where the economic activity has taken place, in many cases, what happens is that companies end up incorporating companies in places where the tax rates are lower and shift their profit from the tax-paying jurisdiction or the economic activity jurisdiction to such low tax jurisdiction. In order to tackle this thing, the concept of global minimum tax is something which was envisaged. It is still not a law per se, at a global level, I would say. But this is something which it tends to ensure or tends to develop a concept that if there is a profit that is earned by a company, then they have to pay a certain minimum level of taxes on such income. They cannot, through various means, devious means or dubious means, they cannot move over the profit of one country to another and thereby denying the country which has a legitimate right to tax those profit, at the same time parking them in the country where there are no taxes. By doing this, even they deny the state of residence the right to tax these profits. So therefore, to deal with all these issues, the concept of global minimum tax was something which was envisaged. And therefore, we are going to see this in this particular session or chapter. So now let's look at the concept of global minimum tax with the help of this diagram. Now, in this case, you have a US company, then you have a Mauritius company, and there's an Indian company. So let's say, for example, this US company actually wanted to incorporate a company in India. And it knew that if it just incorporates this company directly, what is going to happen is that whenever it sells the Indian company, there would be capital gain, and these capital gain will be liable to tax in US. So what it does is that instead of applying directly to incorporate an Indian company, it sets up a company in Mauritius. Why? Because in Mauritius, let's say the capital gains tax rate is 0 under the domestic tax laws. And until some point in time, I mean, a few years ago, under the India-Mauritius Treaty, the capital gains were also exempt in India. In other words, India did not tax the capital gain because there was a treaty in place, and Mauritius did not have any capital gains tax. Effectively, the capital gains tax on this transaction was 0%. Now, this would not have been the case if Mauritius actually had certain taxes on capital gain. Therefore, to deal with such cases, the concept of global minimum tax becomes handy, under which the minimum income which the person earns, or actually the income that a person earns, will be subject to a minimum tax on a global basis. So if, let's say, for example, the Mauritius company does not pay any taxes on this income, the US company, which is the parent company, or rather let's use the word ultimate parent company, it will be under an obligation to include such income in its taxable income and pay global minimum tax on such income. Other cases where this could be applicable is that if the Indian company was to incur some expenditure and this expenditure was exempt in the hands of the Mauritius company, right? Due to this tax planning, the overall tax on such income, which is expenditure for the Indian company and income for the Mauritius company, might be reduced to 0%. Under the global minimum tax regime, there are provisions that any such income which is paid to a company in what is known as a low tax jurisdiction will be taxed. And the taxation can be through two rules. One could be a potential rule where no deduction is allowed in the hands of the payer for such income. And the second one could be that this income may be included in the taxable income of the ultimate parent entity. More on this as we go through these provisions and look at them in detail. Thanks for watching this video on international tax. If you want to enhance your career in international tax and learn everything about how to interpret various articles of a tax treaty, learn about BEPS, global minimum tax, and similar concept, you can subscribe to our online course on international taxation, whose link is given in the description below. If you have queries, you can reach out to us. Look forward to having you on board with us for our course.